Investors, I got 6 dividend stocks for you today. And the honest truth is I was actually going to make a video breaking down some of the top monthly paying dividend ETFs, just given I know how many of us enjoy receiving monthly passive income. And just more than that, I know that dividend ETFs are incredibly reliable for the vast majority of us if we're actually looking to live off of dividends. But here's the thing. The market as of right now is just in a total state of flux as investors have been reacting to fears about President Trump's next move when it comes to tariffs, and then the legitimate possibility at this point in time of a trade war. Not only that, but plenty of data sets have just proven to be, well, not so hot as we once again are hearing the R word, recession, in the news more and more. So with that said, I figured I would actually take another week here just to talk about individual stocks with all of you, and that's just because of their ability to typically outperform ETFs, and if we're talking about total return, really deliver through on a much more lucrative ROI. Of course, I hope the stocks that I'm about to mention do just that for you, but without further ado, I just want to jump right into it with the most obvious of picks in my opinion at this point in time, but they fall within the tech sector, and the first stock that I want to talk about is Microsoft. That's ticker symbol MSFT, which is just the dominant software kingpin out there, one of the Magnificent Seven. But here's the deal when it comes to Microsoft right now. It just released its own chip not too long ago and will remain relevant well into our future because of it. But we also have to understand that this company is just a software behemoth, and Microsoft recently releasing that chip was world class and took the market by complete surprise, but changed the game for a lot of its competitors. And in my opinion, with the future being AI and quantum computing, well, there's no reason that we shouldn't be looking into some of these players like Microsoft, especially right now at Microsoft's insanely low prices rather recently, with the stock trading for $395 per share, which prospectively speaking is way off its peak, as you can see here, of nearly $450 per share not long ago. And if we click into the 5-year chart, you're going to get a glimpse of its true power with over 144% worth of share price appreciation. So remaining long on Microsoft will certainly just deliver. Now, better yet, I want to go ahead and have you scroll down with me to see the financial statement and take note of the fact that revenue is still increasing, as we can see here, by over 15%, all while net income also shoots up by about 21%. Coming down to Microsoft's balance sheet, which is what really matters, it remains extraordinarily clean. $512 billion in assets to just $243 billion in liabilities, meaning Microsoft is prepared to weather all storms. Now, let's go ahead and click over to Simply Safe Dividends. Of course, we're not going to see the biggest yield, given it's a tech play. However, we ultimately replace the crazy high dividend yield for crazy high growth. Nonetheless, Microsoft has a 99 safety score, comes in at a 0.84% dividend yield, right in line with literally Walmart. Now, we also see here that Microsoft's payout ratio comes in at 25%, continuing to grow here at a 16% growth rate, not too shabby. However, if Microsoft just rubs you the wrong way, but you still want your hands on an absolute growth powerhouse, look no further than the very platform you're actually using to watch this video. Google or Alphabet or YouTube, it's all the same. Google, which also recently developed a chip of its own to compete with all the other chip players. But I also would make a strong case for each and every one of you that Google, as of right now, is one of the best Mag 7 stocks to load up on. It's also a dividend investor's dream pick in this arena. Why? Because both its business model and the balance sheet provide plenty of safety to the risk-adverse investors like dividend investors. And right now, it's trading similarly to Microsoft in the red. Now, truthfully, even I have been a buyer this past week, and how could I not be at current prices? Google currently trading for just $172 per share, and even earlier this week, $160 range. But don't fear all the near-term trouble and noise. Look into the future and click the 5-year chart with me, because we're actually going to see how Google performs over the span of time. Even more than Microsoft is coming up with 166% worth of appreciation. Now, scroll down to see a nice 13% increase in revenue and a whopping 35+% increase in net income. Impressive. Balance sheet wise, it gets even better with $450 billion in assets to $126 billion in liabilities. Very clean. Now, jumping over to Simply Safe Dividends, I want you to take note of the fact that the dividend safety score is a tad lower here, coming in at an 80, with a much lower dividend yield here at just 0.47%. Now, scrolling down, we're going to also see that Google's dividend growth rate is coming in at 10%, leaving a lot of room for Google's future to continue to jack up that dividend growth rate. Now, why am I sharing 2 tech stocks with you right off the bat? Simply because I see so many of you investors out there focused on the dividend yield and just forgetting about the power of being focused on dividend growth stocks or growth stocks in general. Not to mention these Mag 7 picks hardly go on sale. sale. So we have to take complete advantage of them when they're actually on sale. With that, 2 down and 4 more to blitz through. But before I go any further, investors, I do want to ask you to hit the subscribe button for me, as it really does help this community grow and of course get the word out there. Now, unfortunately, more than 50% of you are tuning in literally every single video, but not subscribed. Now, for the life of me, I can't figure out what's going on. So at least comment down below with why you're not subscribed, but go ahead and take that step now. Subscribe, tap the thumbs up button while you're at it to let me know that you're actually getting value from this video and want more listicle type videos. But let's go ahead and get to the next stock here, as we're going to go ahead and dive into a heck of an opportunity right now with T. Rowe Price, ticker symbol TROW, which is a money management firm, and its share price is directly correlated to tech stocks, given their assets all fall within the NASDAQ. All of this to say, when tech actually nosedives, like right now, T. Rowe Price's share price follows suit. So clicking into the stock chart, we're going to see firsthand that the stock is down now, trading under $100 per share from over $116 weeks ago. And what I really want you to see in the last 5 years is that, well, the conditions call for it, like lower interest rates, tech companies flourishing. T. Rowe Price is off the charts, as you can see in 2021 and 2022. Now, I foresee the future heading in that direction. However, scroll down with me to see what matters the most. We're going to see that revenue continues to flow in regardless of that share price, up over 11%, as well as net income increasing during this time too. As for the balance sheet, insanely clean. We have over $13.4 billion in assets, just $2 billion in liabilities. But as dividend investors, I have a hunch that you're going to love this T. Rowe Price opportunity even more when you understand its dividend metrics. So let's go ahead and click into Simply Safe Dividends. We get a safety score here of an 80, a dividend yield coming in at 5.12%, which is insane, and then a 53% payout ratio, solid streak of 38 years, and on top of that, a 13% dividend growth rate. But pulling back from any and all tech-related investments, we can jump into agriculture with Turo, which is in the business of manufacturing anything from engines to farming equipment and all of the in-betweens there. But notable factors here with Turo is that tariffs are going to hit this industry hard, and farmers are going to struggle a bit, but that leads to then sales declining, and in this environment, it's going to send the stock to lower lows. So clicking into the stock chart, we're going to see just that. It's in the red right now, down on the year, trading for $74 per share from over $87 months back. Now, clicking to that 5-year chart, we're going to see that Turo and even its competitors, if you go out and find them, you're going to see them just ebbing and flowing as the economy ebbs and flows as well. So the real key here is buying it at a time like right now in the valleys, because if we scroll down, we're going to find a company that is, despite it all, bringing in revenue, and more than that, it has its net income up over 27%. Moreover, if we scroll down even further, a clean balance sheet at $3.5 billion in assets to just over $2 billion in liabilities. Now, as for that dividend, well, Simply Safe Dividends has the stock rated at a safety score of an 84 with its 2.04% dividend yield. We also have a 35% payout ratio, a 32-year dividend streak that continues to boast a strong, robust dividend growth rate of 21%. But we'll keep on the move here and head in a different direction with a stock that's also wavering at this point in time, just given the state of the market and the environment that we're in. We have one up in Canada here with Canadian National Rail, ticker symbol CNI. This is a company with thousands upon thousands of rail laid crossing even into the United States and deep into the South for that matter in terms of logistics. Now, yes, tariff scares along with inflated prices have spooked investors away from this opportunity, but just know that this is an essential company. It provides a range of transportation services, including rail, trucking, and marine logistics. It focuses on moving automobile parts, fertilizers, forest products, grains, metals, materials, coal, and consumer goods. It's just specialized in services that include literally almost everything that we need on our day-to-day. So my advice for this stock is, if you don't want to buy it now, give it a hot moment to actually see where it goes, but keep your eyes on it. Let's click into the stock chart to see that it's been wavering, as I shared. The 5-year chart depicts the real downfall here, whereas it was trading for $128 per share before all the tariff mayhem started, but here we are today at just $101 per share. Scroll down to see revenue continues to pour in, even though it's been crazy rather recently. The balance sheet depicts health with over $57 billion in assets to just $36 billion in liabilities. But the reason I personally love Canadian National Rail all comes down to the dividend metrics. So let's go ahead and click into Simply Safe Dividends together. A safety score here of a 97, coming in with a 2.4% dividend yield. And scrolling down even further, a 46% payout ratio with a dividend streak of 28 years thus far, but keeping strong with a 15.3% average dividend growth rate. However, if there was one stock today that I'd really be watching closely, especially if you're looking for a beautiful buy and hold opportunity, it would be Visa, ticker symbol V, which is merely essentially a transaction facilitator that generates its revenue from charging merchants after all of us are swiping our cards with those merchants. So plenty of upside opportunity with minimum risk. Now that's exactly what I always look for and how I like it. However, as our economic environment remains uncertain at this point, consumers seem to be a little weary, it's the perfect storm to have this type of moat-worthy company come down just a tad here in the share price, which is what we're seeing right now at $344 per share. Nonetheless, as you can see, it is up on the year overall, that peak at $362 per share. Now on the 5-year chart, we're going to see that Visa soared by over 86% worth of appreciation. And of course, coming down to that income statement, here's where it matters. We get revenue flowing in up by over 10%, net income up by over 14%. And on top of that, a healthy balance sheet at $94 billion in assets to $55 billion in liabilities. Now let's dive into these dividend metrics together. We're going to find a 99 safety score, a smaller yield at 0.69%, but be in this one for the long-term dividend growth. We have a payout ratio at 21%, a 16-year dividend streak thus far, going strong at a 17.7 average dividend growth rate. Now investors, there you have all 6 of them. I want your thoughts on these picks and let me know if you actually have better dividend stocks in mind. The entire community could use your thoughts, so comment down below. Subscribe to the channel. For the love of the dividend gods out there, subscribe, and I'll catch you all in the next one.